Our third paper will be is carbon risk priced in the cross-section of corporate bond returns. Quan from Georgetown University is going to present the paper. Quan, you have 20 minutes.
I'd like to thank the conference organizers to incorporate our paper to the program. This is a joint work with Tinghua Duan from IESEG School of Management and from Weikai Li from Singapore Management University, who's also in the audience today. So this paper is about climate finance as well as asset prices. As you know, climate change has a significant economic as well as social impact. And one of the primary reasons for climate change is caused by accumulation of carbon dioxide. And any regulation will have to target at reduce firms' carbon emissions. So here's a figure that talks about the carbon bubble, which also talks about the remaining carbon budget we have. And as you can see here, we only have about 565 billion tons of carbon dioxide until the year of 2050, and still have a reasonable chance of staying below 2 degrees Celsius of global warming. And this is actually pointed out by a lot of research notes. For example, one research note noted that a third of oil reserves, half of the gas reserves, and over 80% of coal reserves should remain unused. And the IEA estimate basically talks about more than 1/3 of the proven reserves can be consumed in order to achieve this goal. So this so-called carbon bubble hypothesis is basically talking about the valuation of companies depending on this carbon emissions. The main idea is that the true costs of carbon dioxide in the role of global warming have not been taken into account in a company's market valuation. And when there's changes in government regulations, this should most likely affect all those carbon-intensive firms. And you can think about this effect from both the production perspective as well as financing perspective. And once such policies are proposed and implemented, chances are very high that this might lead to lower firm values. So this leads to one of the most commonly stated hypothesis in this literature, that is a carbon risk premium hypothesis. The idea is that investors should demand higher expected returns for holding securities issued by carbon-intensive firms. So in this paper, we systematically examine this carbon risk premium hypothesis in the US corporate bond market. The main idea is related to this downside risk applying to the corporate bond market proposed by these papers. And also, if you think about the Merton classical 1974 paper where the equity is just a long call and debt is a short put, so bond investors should be more sensitive to downside risk imposed by this government regulation changes. And also, what's more importantly, there are different frictions between the equity and bond market, such as different clienteles, the risk appetite might be different, and the shorting costs might be different as well. And also, there could be different regulatory capital or funding liquidity constraints that might lead to different predictions of the pricing of carbon risk in both the equity as well as the corporate bond market. And also, I'd like to point out that in the US corporate bond market, the dominant players are institutional investors who might be very sophisticated. And there's a very nice paper by Kruger, Schottner, and Starks 2020, who pointed out that over 50% of the institutional investors start believing the regulatory risk of climate change already materializing. So in this paper, we really rely on a lot of important bond characteristics such as ratings and maturities, trying to test the underlying channel of the pricing of carbon risk. And another motivation we basically had is related to this fragility in the corporate bond mutual funds market in the US, documented by Goldstein, Zhang, and An. And one of the sources or channels that we were thinking is that probably the climate concern is one of the sources for this fragility in the US corporate bond market. All right, let me briefly talk about the preview of empirical results. We measure our firm level carbon emission intensity as a scaled version of carbon dioxide emissions. So think of this as the total of CO2 emissions scaled by the total revenue of a firm. So it's size adjusted and it's independent of size. And contrary to the commonly believed carbon risk premium, we find the opposite evidence in the US corporate bond market. So we find that despite the fact that high carbon intensive bonds are riskier than low carbon intensive bonds, if you look at their market beta, downside risk, credit risk, as well as liquidity, those bonds are actually riskier. However, high carbon intensive bonds significantly underperform, not outperform, by about 2% per annum relative to those low carbon intensive bonds. So we basically call this empirical finding the low carbon premium, and it's quite persistent. It's robust, adjusting for systematic measures as well as controlling for different bond characteristics. So this really motivated us to think about what kind of theory should be used to explain the low carbon premium in the data. And one of the hypotheses we had was proposed by Pasta, Stambauer, and Taylor 2020 is related to investor preference. So the main idea is that think about green assets. They could outperform the brown assets if investors' preference or ESG preference or concerns strengthen during that specific sample period. And if we are happening to measure returns during that time period, we could find this low carbon premium hypothesis. We test this explanation, and our answer is yes and no. Yes, in terms of the evidence that institutional investors, on average, indeed, they are divesting from bonds issued by carbon-intensive firms. However, this is not the full picture, because when you control for this institutional demand, this low carbon premium is still there. It cannot be fully explained by shifts in institutional demand. And then we're testing another possible channel proposed by Peterson and his co-authors, which is called the investor underreaction hypothesis. The idea is very simple. It's kind of related to inefficient pricing of carbon risk in the US corporate bond market. The main idea is that firms with high carbon emissions might have deteriorating future fundamentals, yet the market does not react to this return predictability in a timely manner. And we do find supporting evidence, as we find that high carbon intensive firms, they tend to have lower future cash flow news. They have deteriorating bond credit ratings. And what's more important is they have more frequent environmental incidents, as proxied by a few environmental incidents data compiled from the RICS. So in terms of the contribution and related literature, our paper is more related to the second strand of literature that talks about regulatory as well as translation risks. So if you look at this paper, they examine the pricing of climate risk in the option market, in the stock market. And the last paper here talks about, the pollution premium. The first strand mainly talks about physical risks, which we are a little bit distant from. Also, our paper is related to a broad literature focusing on firm ESG and the equity market performance. And the third strand of literature really speaks to the cross-sectional determinants of corporate bond returns, where most existing literature talk about systematic risk as a determinants of the cross-sectional corporate bond returns, and we're linking climate finance to the US corporate bond market. All right, let me move to data briefly. So we're relying on this firm-level carbon emission data compiled from SP TrueCost. It's a firm-level carbon emission data, and we compare the sample coverage to CompuStar. It's the quality improves over time, and it's quite representative in terms of the market cap. And we're primarily focused on different scopes of carbon emission. There are 3 scopes. Scope 1, think of this as direct emission from the firm. Scope 2, those are the indirect emission from the supply chain. Scope 3, we do not rely on this much because it's imputed from the data, and a lot of the observations are missing. So our primary focus or empirical measure in this paper is Scope 1 as well as Scope 2 carbon emission. Just to give you some flavor of how this carbon emission intensity changes over time. So it's a scaled version of the carbon emissions by the revenue. And as you can see, it decreases over time, indicating more efficient carbon intensity over time. And let's just keep this 300 on average for the scope 1 carbon emission in mind, because I'd like to show you some exhibits related to the standard deviation. So the carbon emission intensity varies a lot across Pharma French 12 industries. As you can see, the top 3 most carbon intensive industries are pretty much utility, energy, and chemicals. So in all our empirical tests, we try to control for all these industrial effects because we don't want all our results just to be driven by this cross-industry effect. And we also try to exclude the most carbon-intensive industries, and our results will still be there. And what's more importantly, cross-sectional variation of carbon intensity across industries is also very pronounced. However, even when you dive deeper within the similar industry, the same industry, there are still a lot of significant cross-sectional variation among the firms within the same industry. As you can see, the standard deviation over time, on average, is about 600, twice as much compared to the mean. So we think that this result is also suggests some evidence of this firm level carbon variation we're trying to capture. Finally, we're merging this firm level carbon emission data with the corporate bond data, very standard from enhanced trace. And then we merge with merge and fixed income data set to get all those bond characteristics. Bond return is also very standard by taking into account of coupon payments, accrued interests. So finally, our sample includes about 20,000 bonds issued by over 1,000 firms covering this sample period, and 75% of the whole sample are investment grade, and the remaining 25% are high yield bond. All right, the risk factors are also based on the current literature because we are trying to calculate the risk-adjusted returns of carbon emission sorted portfolios. So we rely on the standard stock market factor, and then we also rely on the standard bond market factor, and then we combine all those factors to create a comprehensive 9-factor model. So in all our empirical analysis, we're trying to focus on the risk-adjusted returns, or the alpha, coming from these factor models. Okay, so let me move to empirical results, and let me briefly talk about one of our central findings on the univariate portfolio. So the portfolio formation here is in the spirit of Pharma and French, the most classical one going back to the size effect. At the June of each year, we form quintile portfolios of the bonds within each of the Pharma French 12 industry because we want to control for this industry effect based on the firm level carbon emission. And then we hold the portfolio for 12 months so that the portfolio is only rebalanced each year, and we calculate the value weighted portfolio returns, averaging across all these industries. So eventually, all these portfolios have a very well-balanced firms from different industries, and to make sure we're not capturing this cross-industry effect. So here's one of the tables that shows this low carbon premium. As you can see, high carbon intensive bonds on average underperform those with low carbon emission by about 14 to 16 basis point per month. So if you multiply by 12, we're talking about approximately 2% low carbon premium per year. And this is robust to different factor models, stock factor, bond factor, or the combined 9-factor model. And by the way, I think if you look at all those T statistics, it seems that the result is mostly driven by quintile 1. So the bonds with issued by firms with low carbon emission in terms of the source. What's interesting is that high carbon intensive bonds are actually riskier. Quintile 5 compared to quintile 1, those bonds in quintile 5 are actually riskier, proxied by the bond market beta, downside risk, illiquidity, and credit risk. Yet they deliver significantly lower returns, which is the low carbon premium we talk about. And we have plotted the cumulative returns for the long-short bond portfolio over time. And as you can see, it's quite persistent. It goes up until the year of 2016, but there's no huge drawdowns. It's kind of like a momentum crash. We don't see kind of crashes in terms of cumulative returns. However, after the year 2016, the low carbon premium actually declines. So it actually flips the empirical results. And one of our conjecture we had in the paper was related to the implementation of the Paris Agreement at the end of year 2015. And we relate this to investor attention story where we examine a little bit. The results are also robust to the Fama-Macbeth cross-sectional regressions, where we control for a lot of bond characteristics as well as systematic risk measures. As you can see here, we've controlled for characteristics, systematic measures, as well as bond climate news beta, and we also control for all those industry effects. But the main results still suggests that there is a negative relation between carbon emission and the expected corporate bond returns. In terms of robustness, in terms of robustness, we are trying to rely on different scope of carbon intensity, and we also look at firm level evidence. The results are not also driven by the global financial crisis, and it's robust to alternative factor models. So I'll spend the rest of 5 minutes talking about the source. In order to test this low carbon premium, we try to test the investor preference hypothesis by Pasta and his co-authors. And anecdotally, I think there are some evidence talking about institutions commit to divest this fossil fuel industry in terms of those firms with higher carbon emissions. So our empirical test basically try to answer the question, first of all, are institutional investors divesting high carbon intensive bonds? The answer is yes. As you see from equation 2, there is a significantly negative relation between carbon emission intensity as well as future institutional ownership changes. However, when you control this dependent variable, when you throw it as an independent variable measured as the contemporaneous change in institutional ownership, the lambda 1 in equation 3 is still significantly negative, basically showing that when we control for institutional demand, this negative relation still persists. So this table is basically the yes question I basically presented to you. On average, they are divesting bonds with associated with higher carbon emission, and we're talking about a 13% reduction relative to the mean institutional ownership change, but you still observe this negative relation. So now we move to the another hypothesis, that's the investor underreaction, and we do show that for some descriptive statistics, higher information asymmetry among those bonds will give you more investor underreaction because the result is more pronounced in non-investment grade bonds, longer maturity bonds, as well as liquid bonds. And also, as I shared with you, post the Paris Agreement, the low carbon premium gets weaker, and the time series of this low carbon premium seems to be related to the investor attention because we constructed some Google search volume on topics such as climate change and global warming, and it's still there. And then we formally tested this investor underreaction hypothesis by using different proxies of future firm fundamental, such as unexpected earnings, earning surprises, revenue surprises, cumulative abnormal returns around the earning announcements. And we show that on average, investors are negatively surprised by high carbon emission bonds, so that the lambda 1 is significantly negative in most of our empirical predictions. So this is the cash flow results. As you see, when we use SUE, the earning surprise, revenue surprise, cumulative returns, we have a solid negative relation. And then when you use some other proxies, such as changes in credit risk, and we show that higher carbon emission predicts future deteriorating in credit rating for a lot of firms. And we also rely on some other accounting-based measure of credit risk or distress risk by using Olson's O score. And this result still suggests very similar evidence. Firms' fundamental will be deteriorating in terms of credit downgrading. Finally, we look at environmental incidents, and we show that firms with higher carbon emission tend to have more environmental incidents in the future, which could be one of the channels on the poor firm fundamentals in the future. So due to time constraint, I'll skip this result I already shared with you. So let me conclude. In this paper, contrary to the commonly believed carbon risk premium, we find the opposite evidence, which we pitch as the low carbon premium. And we propose different hypotheses, and we find supporting evidence in support of the investor underreaction. So that's all. Thank you. Look forward to Hong's discussion.
Thank you. Thank you, Chen. So I will share my screen and discuss. Yes, right. Okay, good. So Quan, please help me to control the time. If I go beyond the 50 minutes, please stop me.
Problem.
Thank you very much. I'm Hong from PBC School of Finance and Tinghua University. This is a great paper. I feel very happy to have a chance to discuss this paper. Let me first say that, let me first briefly summarize the paper. They find that bonds with high carbon kind of emission, they will have a lower return. So this itself is a very interesting result. And the effect is not explained by a lot of other factors known to the bond market, and it is not related to the holding change of institutional investors, and as Quan had explained. Now, what could be the potential economic ground? I think this is a very interesting part. Investor underreact to some of the signals sent by the emission kind of the index. Okay, so basically, I think the takeaway message from this paper, there are two. Both are very exciting. One is that we have seen green bond outperformance rather than a carbon risk premium, which indicates polluting bonds should or polluting firms should receive higher return. So this is very different from a list of existing kind of the evidence. But of course, later on I will also show that actually the evidence in this part of literature is quite mixed. Okay, so it's a good time for the authors to clean up the literature. The second one is I really appreciate their great efforts to basically nail down the economic channel by comparing their results to the two their concurrent models about how premium or discount can be generated by green assets or brown assets. Okay, one is the Patterson model, one is the Pasteur model. So I also going to discuss this. So overall, I think it's very timely because the topic is very important and the evidence is quite mixed. And I don't have much concerns about the empirical results. Actually, I learned quite a lot of details by reading their description. They do a very careful job in terms of empirical analysis. So what am I doing here? I think I will discuss its conceptual framework, how tightly the underreaction hypothesis is verified, and I also want to make a few economic want to mention a few economic issues that could be related and be interesting to the study. Well, first of all, let me first discuss about the literature and the position of this paper. The literature is the current literature is quite interesting and mixed. Okay, let me just use one market to demonstrate the mixture. So this is a municipal bond market. Okay, so of course the general question is that what can we say about the municipal bonds that are issued by more kind of the is more green or more brown, which is basically not green. So we have a very interesting set of results. We have a result saying green bonds are issued at the premium. Of course, this is issuing price, so their return is the opposite. Well, but at the same time, around the same time, we also have papers saying that a green bond is issued as at the discount. Okay, and this is not the end of the story yet. We also have papers to say that neither of the above is correct. We actually have zero premium about the green bonds in this market. Okay, and this is actually forthcoming GH paper. And there is also other papers to look at other perspectives like the costs, issuing costs of the bond in the market. Okay, municipal market. So basically, we can see that the empirical evidence in that particular market is very mixed. And I mentioned this particular market because this somehow is related to the corporate bond market that this paper is examining, right? So it's very related. Then on the other dimension, what about the firm level? Because for municipal bonds, local, we can think that these local counties issue those bonds. What about firms? Actually, we also have a list of quite mixed evidence about the firm level green or brown premium. Let me just mention a few of them that could be most related to this paper. Some of them I will discuss later on. One is that what about the stock? Do we see more carbon intensive stocks? Their firms, their stocks is going to have higher expected return in the future. And again, we have opposite kind of the results reported in the literature. Then Chava has a paper saying that what is, let's say, suppose we look at not only the stock, we also look at the bond side, or not bond side. In the paper, actually, it's a loan side, bank loan side. But we look at both the equity and the loan, this kind of the comparison. So they actually find some consistent result between equity and loan. And their result supports kind of the carbon premium, risk premium. Then lastly, among the corporate bonds, there are green corporate bonds and the remaining corporate bonds. Then Flammer has a paper to say, what about the difference between green bonds and other bonds? Then the conclusion is that the green bonds doesn't seems to imply a cheaper financing, but it does signals some future commitment for the company to do something green. Okay, so this I think is highly related to the paper of this paper. So based on these kind of the literature, I think it's a great time for us to completely understand what is, let's say, green premium or brown premium across different type of securities and across different type of firms. Okay. All right. Then let me move on to comment on the, let's say, the conceptual framework. The paper actually discussed in details about the two conceptual frameworks. Okay. The first is the model of Pastel, Stenberg, and Taylor. So the key idea of their model is very simple. So investors have different or multiple dimensional and heterogeneous preference over, let's say, ESG or green, this kind of the things. So for instance, investors can derive utilities from ESG. They can also have some other preference. And the general prediction out of this assumption is that there is a long-term green underperformance. Basically, green assets will underperform in the long run. Okay, and of course, they also mentioned that the opposite empirical finding can also arise in this model if basically green assets can outperform. Okay, if ESG tests basically their preference has unexpected increase or strengthening during a period. So if you just measure the performance during this period, then you will see the outperformance. Okay, so this is actually the paper had also been discussed. Then what about the other Patterson's paper model? Actually, they have three different types of investors. The most important thing is that they add another important assumption that ESG actually predicts future profitability. Okay, so this is a key additional assumption. And based on this assumption, if they are investors who ignore this profitability signal, ignores the information, then we are going to have expected future realized return. Okay, so their idea is I can quickly summarize here. So if investors unaware of ESG, unaware of the informativeness of the ESG dominates the population, they are the marginal investor, then we have high ESG means high future return. Future return means realized return because these investors fail to incorporate these messages. Okay. Then we also have different other scenarios. What about we have ESG motivated investors? Then we are going to see a lower expected return. Okay. And this paper mainly resort to or discuss about the first phenomenon. It's a first hypothesis because this is consistent with underreaction. Okay, and I'm very impressed that they bring a lot of evidence on, let's say, how actually the carbon index can predict fundamentals, predict the deteriorating fundamentals of the firm. Okay, they have very different measures. Okay? I want to comment on this part because I want to make sure that the discussion of the empirical and the theory is very tight. Here I want to make one caveat. The caveat is that a positive signal alone does not yet complete the picture of the green premium. Okay, so the reason is that in their framework, because they're talking about the signal informativeness of the ESG score or green index. So a positive signal basically has two implications. One implication is that it will forecast the future dividends in the model or profitability. The other one is that the investor demand could change. Okay, so this is another very important dimension. The net effect actually is a combination of the two to see which effect will dominate. If the informativeness is largely ignored, then we're going to see future high expected return. But if you include investors with high ESG preference, you can think that these guys have a lower required discount rate for the assets, so the asset will have lower return. Okay, so the result actually is depending on the combination of the two. So let me say that in this regard, actually in the paper they discuss how we starting from the signal, let's say from the governance, from environment, and how the signal predicts firm fundamentals, then how it shapes the investor demand, and very importantly, whether this signal has been incorporated into the current price. Then based on this, they can infer whether future return will be predicted by this signal or not. Okay, so this is a basic framework. Now, getting back to the let's say the empirical results of this paper, actually, I appreciate quite a lot that they actually discuss not only about the fundamental, also about the investors' potential on the reaction. Okay, so they regress earnings shocks on this index, and they also regress the CAR on this basically the market response to this index. Okay, so I'm a little bit struggling with the interpretation of the second one because basically I think SUE and the CAR, they are corresponding to each other, right? So it's kind of difficult to assign one result with the fundamental, one result with the investor on the reaction. Also, I have some explicit, maybe a little bit explicit questions. That is lagged carbon index an unbiased signal of those future fundamentals or not? I think this has a lot to do with interpretation of these result. Okay, that's the first thing. The second thing is that which investor is influenced. Okay, because CAR is measured in the stock market. If we believe that bond and stocks they have different investor clientele, then it is not necessary a signal about the investors, right? So with this concern, I revisit their bunch of results together. Actually, in their tables 7 to 10, they talk about the predicting about fundamentals. They talk about how investors, institutional investors, respond in their table 5 and 6. Okay, so they actually did quite a lot of work. My current feeling is that the observations can be consistent. The investor demand about the institutional investors, their shifts, can be consistent with the hypothesis, but it is not a tight consistent yet, because it can still be consistent with that these guys shift, then they just change maybe the concurrent price. So it's still unclear whether concurrent price is incorporating the signal or not. Okay, so this is something I think that the authors can further improve. Also, I when I read through these two tables, I kind of have the feeling that, or mixed feeling that, is this a good rejection to the Pastel-Sternberg-Taylor's hypothesis? It is a bit stretching. The reason is that yes, we can see holding change may not predict return, but their model is actually talking about preference change. Preference change can lead to holding change, but holding change, is this necessarily reflects preference change? This I'm not sure. So in both cases, I think more discussions about investor clientele, investor preference, and the current price could help a lot about this analysis. Okay, so this is my largest comment. Then I have several minor ones. Let me just bring them quickly. The first one is in the literature, in the bond literature, municipal bond literature I mentioned before. The two published paper or forthcoming paper, they are actually talking about the two different layers of economic story. One is about the issuer, the heterogeneity of the issuer leads to the premium or discount. Okay. Another one is look at the same issuer, but they issue different securities. Okay, so the heterogeneity among securities. So my question is that here, do we observe two different layers of these effects? Are they consistent? Because we see that in the literature, it is actually not consistent, right? And here also in the corporate bond paper, I mentioned that green corporate bonds don't differ from, let's say, other bonds in their kind of the returns. Okay. Then let me also say that I also have two more comments. One comment is that if we focus on the premium across different firms, which I think is the focus of this paper, the strengths of the paper, then a natural discussion point, which I'm not completely clear, is what is the role of firm characteristics? Okay, because from the summary statistics, you can see this index load on those the high minus load on these characteristics. This is both good and bad. The good thing is that it signals the informedness, so it is correlated with firm fundamentals. But conceptually, it also raises questions about what exactly the type of information provided by this index, right? Do they provide additional information? Do institutional investors learn about the information? So this is, I think, some conceptual or empirical discussions about the role played by known characteristics will be very helpful. And the last one is coming back to the informedness of this index itself. Okay, I noticed that this index is scaled by revenue. Okay, if it is scaled by revenue, if we look at the paper of Bolton and Kopsachik, actually they show that whether you scale the carbon emission or not has a significant impact on their predicting power. Okay, so the revenue in their analysis seems to add noise into their kind of return analysis. So my question is economical. How can we understand the role of revenue? Definitely, it will provide some information, right? Can we make this information to reveal the potential economic channels behind this ratio? Let's say, are there sunk costs? Are there kind of entry barriers for those polluting firms with low kind of the revenue? Then in this case, actually, we understand why there is some very sharp kind of information delivered by the polluting, right? One, we are scaling with revenue, okay? Because these firms simply lacks ability to do this, okay? So I think clarification about this kind of the economic source will be of great help to further clarify the source of this the economic source of this picture. Okay, so I think I'm running out of time, so let me just conclude. It's very interesting and very timely, and I think it can be better aligned with the theoretical foundation, and some economic questions can further sharpen the economic picture. Okay, so that's all. Hope these comments will be helpful. Quan, you want to respond?
First of all, thank you so much, Hong, for your very thoughtful discussion. I know you have relevant papers in the field of muni bonds, and you also have papers talking about the financing side of the firm. So I think all the comments are really well taken. So I think we will definitely try very hard to relate our paper to the broader picture of the muni bond market. As you see, there is a lot of mixed evidence there. And also your comments on the cash flow effect versus the discount rate, I think that's something we will definitely try to straighten out a lot more. And also the event study you mentioned is very interesting, because in the stock market, the cumulative abnormal return or investor surprises can be constructed easily using equity data, right? But in the bond market, to address your comments, maybe it's helpful for us to think about event study in the corporate bond market. I think Hank Bensenbider has a paper which talk about event study using bonds, and then we probably can rely on the methodology from that paper to think about event study using bonds. But we'll also have to check the data quantity, because a lot of bonds probably, they don't have a lot of daily returns around the events. Also, the heterogeneity in the bond investor is also very interesting. As far as we know, the dominant player in the bond market are institutions. So there could be insurance companies. Maybe we will relate our paper to the motivation of why this bond investors trade and as of when. So that's something we will definitely do. And also the heterogeneity, I think we will be working on this very soon. The issuer effect versus the security effect, so that we can pin down what's the effect within the firm, how we can talk more about this. So I think that they are very valid points, very well taken. Yeah, thank you so much. Weikai, you have any comments or you would like to? So
no, I just want to thank Hong for the very insightful comments, and all the points are well taken. We will revise the paper based on your comments. Thank you.
Thank you. So let's also open the discussion to the audience. Any questions from the audience? You can type or just unmute and directly raise questions.
Hey, can I ask a question?
Sure, please.
Hey, nice paper, Quan. So I just curious, like how to reconcile. So I think Hong also mentioned this. So I just curious how to reconcile the differences with the findings in the corporate bond versus the stocks. I just wondering if you replicate all your analysis in the stock market, what do you would find? And would you also find the reaction? Because given all the literatures, like the paper by Kylie and Paul Xu, they show actually it's the opposite, right? So I guess another way to put my question is like, what make the corporate bond market different from the stock market, and why the results are different?
Very valid question. So I can try to answer your question, and Weikai, feel free to join in. So basically, I think the research design is a little bit different from the Bolton paper. Originally, we are thinking that we might find very similar evidence in the bond market as in the stock market, because to the extent that bond investors are more subject to downside risk, and this downside risk should matter more for bond investors than the equity investors. But then what we do is that we focus on the common sample of firms that issue bonds as well as having equities. And using our measure and using our research design, we actually find very consistent evidence. So I know that Roger just pointed out we shouldn't pitch the low carbon premium. So I will change the phrasing. But basically, we still find that for those subsample of firms, you're gonna observe similar evidence as firms with high carbon emissions still significantly underperform. So my understanding is that their measuring of returns is a little bit different from ours, because if I remember correctly, they are measuring contemporaneous returns, not future expected returns. And as Hong mentioned, they're using the raw measure instead of the scaled measure, which is the carbon intensity. I think what we can do is maybe try to use the raw measure Hong suggested, and then think about how we can reconcile the paper. I think it's a very interesting question you just raised, Wenxi, because I think the most ambitious picture of the paper is to write down a stochastic discount factor model, talking about what determines the expected returns of equity versus the expected return of bond, using a lot of covariates, and then think about the frictions that break this SDF, and then think about what kind of covariates that matter for which market. Yeah, but we're not as ambitious now. But you're right. We will definitely look at talk about and reconcile the stock market evidence. Yep.
Thank you. Yeah, very interesting paper.